Take a look at your smartphone, your car, or even the wall behind you. Do you see that crisp white color? That's titanium dioxide, the white gold of the chemical world. It's a $20 billion industry that literally colors our reality. But right now, this industry looks like it just ran into a brick wall at 100 miles per hour. Today, we're dissecting the 2025 wreckage of the three titans, Chemours, Tronox, and Kronos. We found a hole in their pockets the size of a crater, and if you're an investor, you need to know who's actually going to survive the tsunami. Let's talk about ghost factories. In late 2025, the industry hit a utilization rate of 55%. To put that in perspective, imagine owning a 100-table restaurant, paying for 100 chefs and 100 waiters, but only 55 people show up for dinner. You're burning cash just to keep the lights on. This isn't just a slow period, it's a historic cyclical floor that's forcing the big boys to stop the machines and pray for the housing market to wake up. Why is this happening? It's a triple threat. First, expensive money. High interest rates have frozen the housing market. Nobody is buying new houses, which means nobody is painting walls. Second, the raw dirt they use to make this stuff, the ore, is getting pricier. And third, trade wars. Countries are throwing anti-dumping taxes at each other, like they're in a dodgeball tournament. It's a perfect storm where making the product costs more, but nobody wants to buy it. Let's look at the paychecks. Tronox is still bringing in nearly $3 billion, leading the pack. Chemours is right behind them, but look at the where. Chemours is basically the king of America. 42% of their money comes from the States. Meanwhile, Kronos and Tronox are heavily leaning on Europe. If the European economy catches a cold, these two start sneezing immediately. It's a game of regional survival. This is the truth table. This is where we see who's actually keeping the money they make. Look at the EBITDA margin. Tronox is keeping 11.6 cents of every dollar. Chemours? Only 6 cents. And Kronos? They're barely keeping 2 cents. Why? Because Tronox owns their own mines. They don't have to buy the flour to make the bread. They own the wheat fields. However, look at the inventory. Tronox has 229 days of stuff sitting in warehouses. That's over 7 months of unsold product. That is a lot of dust gathering on the shelves. This is Tronox's secret weapon, vertical integration. In plain English, they own the dirt. While their competitors are out there haggling with suppliers for titanium ore, Tronox just digs it out of their own backyard in South Africa and Australia. In a market crash, the person who owns the source wins. It's a moat made of titanium-bearing sand, and it's the only reason their margins haven't evaporated. 2025 was the Great Shakedown. Companies didn't just slow down, they tore down. We saw a massive exit of high-cost factories. Chemours closed their Taiwan site, Kronos shut down lines in Canada, and Tronox pulled the plug on plants in Holland and China. This is a brutal reset button. They are cutting off their own limbs to save the torso. Now look at Chemours. They realize white powder is a volatile business, so they are pivoting. They are betting big on semiconductors and data centers. See, the same high-tech fluids used to cool AI chips are made by Chemours. Their high-tech segment makes a 32% profit, 5 times more than their titanium business. They are essentially using their old paint money to buy a ticket to the AI revolution. And the innovation doesn't stop. We're seeing a pivot to strategic metals. Tronox is now trying to pull rare earth oxides, the stuff used in EV magnets, out of their mining leftovers. Chemours is working on hydrogen energy membranes. They are trying to turn boring chemicals into future tech. If you're looking for a reason to stay invested, this second growth curve is it. Then there's Kronos. While the others are dreaming of AI and hydrogen, Kronos is just trying to survive. They are in liquidity defense mode. They slashed their inventory to the bone just to keep cash in the bank. They are the most exposed to the high energy prices in Europe. For Kronos, 2026 isn't about winning, it's about not being the first one to go under. Why can't a new player just jump in and steal the market? Because of the secret sauce, the chloride process. It's cleaner, it's faster, and it produces a better white. But it's also incredibly hard to do. Chemours and Tronox own the patents and the know-how. This tech moat is the only thing keeping lower quality competitors from eating their lunch. But it's not all sunshine. There's a hard ceiling, lawsuits. Chemours is sitting on nearly $500 million in environmental liabilities. Then you have the EU carbon taxes and new regulations labeling titanium 4 oxide as a potential hazard. The industry's biggest enemy isn't each other, it's the courtroom and the carbon footprint. These are the hidden holes in their wallets. Let's look at the credit card debt. Tronox's debt is 9 times what they earn in a year. Imagine making $50,000 a year but having $450,000 in credit card debt. That is Tronox right now. Chemours is in better shape, but their net assets are dangerously thin. One more bad quarter, and the risk profile for this whole sector goes from yellow to deep red. So what's the verdict? In this Game of Thrones, the integrated king wins. Tronox has the most debt, but they have the best moat because they own the mines. Chemours is the pivoter. They are the safest bet if you believe in their high-tech future. Kronos? They need a miracle in Europe. The bottom is here, but only the resilient will see the rebound. This industry is moving fast, and the data is changing every day. If you're a fund manager or a strategic buyer, you can't afford to guess. This is what we do at HDIN Research. We turn raw chemical data into authoritative market insights. Reach out to us at sales@hdinresearch.com for the full-page report. Don't just watch the tsunami, learn how to surf it. I'm your analyst from HDIN. Thanks for watching.